Just a little over 2 years ago, Disney hit an all-time high of $203 per share. It is down to 88. Whenever a company of this magnitude falls this much, it's gonna grab your attention, and it should. It's a great place to start to see, is this value here? Is this a good price to buy for the company? That is the question. So, if you're doing this, if you're on our channel right now and this interests you, I want you to remember, every investment's the present value of all future cash flow. And when you buy a stock, you're buying a piece of a business. Disney has its issues. There's a lot of drama going on with DeSantis down in Florida. A lot of stuff going on, but Disney Plus has skyrocketed since COVID. They have way more subscribers, but they're starting to lose some subscribers, I believe. So in this video, if you're a beginner investor or an advanced investor, we have something for you along the way. If you're a beginner, learn, listen, understand. If you like what we're saying, please subscribe to the channel. I guarantee you will learn more. But our goal here is to look at bull cases, bear cases, news on the company, and then most importantly, use our stock analyzer tool to determine what price to pay based on our assumptions about the future for Disney today. So guys, in full disclosure, I do own Disney stock, but I want you to remember, you should not buy any investment because I do or Mo does or anybody in this world does. We want you to we're here to teach a process. If you're here just to get stock tips, we're not the channel for you. We're here to teach a process because my process differs from every value investor that I respect. And they're gonna see things that I'm not gonna see, and I'm gonna see things they're not gonna see. That's the key here. It's about teaching a process. So again, never ever buy an investment I make just because I made it. You will not do well in the long run doing that. So let's go over some things on Disney, some high level items. So $162 billion market cap. That's if you buy every share outstanding on the market. It costs you $162 billion to control every share. Now, enterprise value is 246. This difference right here is debt. What is that, $80 billion in debt? Sounds like a lot. Very well could be, but Disney is a very, very strong company with a huge moat. What's the analogy I always give about Disney?
If somebody gave you, let's call it $162 billion, go start another Disney. Good luck.
Go compete with Disney right now.
Good luck.
Not gonna happen.
Yeah.
That's a moat. Does that mean you go buy it though because the replacement cost is higher? No. Still, every investment's the present value of all future cash flow. Repeat that in your head. Now, 39 PE, 38 5-year PE. And look at this margin, profit margin of 4.7%. That's a low profit margin, especially considering one thing. Mo, this is what interests me about Disney. 4.7% in the last year. Let's go look at it before COVID. Before COVID, they did $70 billion in revenue and had $11 billion in profit. That's what, 15% profit margin?
Yeah.
The year before that, $60 billion in revenue, $12 billion in profit, 20% margin. Year before that, $55 billion in revenue, $9 billion in profit, another 16, 17%.
And every year you're talking about there, they didn't have Disney Plus, which is a high margin business.
Correct. So my thesis on Disney is, if you believe that the profit margin is going to go back to normal levels,
why are you not buying?
Is this a buy?
Yeah.
That's the question. And in our stock analyzer tool, we will show you what we mean by that, okay? All right, now, free cash flow, they cut their dividend during COVID. Free cash flow is down a lot. Same thing though, go to the cash flow statement. Go look at their annual cash flow. Before COVID, 9.8 billion, 8.7, 8.4, 7, 6.5. And then look at it since.
This is the lowest in the past decade.
So I have to ask, like, what's the reason? That's the question you need to ask. Somebody on Twitter recently actually posted something about Disney and said to me, I said, listen, the question here is margins. And everybody was like, yeah, 100%. Are they gonna get back to normalized margins of 15 to 20%? Are they or are they not? Even if they don't get back to normal, can they get to 10%? Because right now their 5-year average is 5.9% and their last 12 months is 4.7. That's a big, big difference.
Yes, it is.
Let's go check out the 8 pillars before we do our bull and bear case. And remember, guys, if you have our software, you can do the custom pillars, up to 12 pillars that give you 4 quadrillion different variations. So it's a good way to just compare our pillars to yours.
Yikes.
1, check.
Yikes.
Revenue growth.
Yeah.
They have record revenue right now. It's incredible right now. Everything else is an X. Everything else. Does that mean you should avoid it? Not necessarily.
No.
So before we go further into these 8 pillars, tell us some of the bull and bear cases.
Yeah, so I wanted to pull up
Disney.
here the Disney Plus subscribers, and you can see it had incredible growth all through COVID into 2022, and then at the end of now it's starting to trickle down. So 2023, they've seen 2 quarters in a row of decreasing Disney Plus subscribers. So maybe I look at this in 2 ways. I look at this as, hey, they went through COVID and they skyrocketed in subscribers, and it's going to come back down. Maybe this isn't the worst thing in the world, but
well, I mean, when you have that kind of massive growth, and the reason why people signed up for it was we're stuck at home.
We're stuck at home, yeah.
And even after COVID, they still grew and grew and grew.
And I think this is, I mean, if they can sustain around this 150 million subscribers, great.
Listen, their goal was like 100 million,
Yeah.
so they surpassed that goal completely.
So fast, exactly.
So let's not punish them just so they did that.
Right. So bull cases, customers age between 2 and 34 years of age make up 70% of the Disney Plus users. To me, those are the people that you keep sticky.
Can I add another bull case to that?
Sure.
Disney has the library of all libraries, and they get to put it on their Disney Plus.
And the cool thing is they can monetize on top of that. So they show you the movie The Little Mermaid. They can advertise for their Little Mermaid products.
Yep.
The kid wants the product, parent goes buys. It's just a vicious cycle of buying.
It's an awesome cycle. It's a capitalistic cycle. Next one.
Cruises. They have increased additional passenger cruise days 22%, and that was a big thing. They went to 0 on that for a while.
Yeah.
They were not cruising at all.
And just today, Carnival Cruise, they're down a lot, but they reported a much narrower loss than expected, revenues up. I mean, their cruises are back, baby.
People are back on the water.
By the way, my family and we talk about taking a cruise next year as a family trip.
Oh, nice.
Yeah, so it's like cruises are back.
I've never been on a cruise.
I've been on one time.
6% higher hotel occupancy from the previous quarter's filing. That's good. People are going back to hotels. Now, bear cases. Disney Plus average revenue per user has fallen 21% since 2020.
Okay, but that's since 2020.
Yeah.
Okay.
It has. Disney suspended its share buyback program.
Oh my God.
I know. When the prices were at the lowest.
Mo, please explain to people why I'm saying, oh my God.
So guys, you want companies to be buying back their shares at cheap levels. And when Disney is at $203 a share, you don't want them buying back their shares. It's a total waste of money. Buy back your shares when it's cheap, when it's advantageous to the shareholder.
That's the thing. People always think that buying back shares is a good thing. No, it's not always a good thing. It's only a good thing when they're buying back cheap shares.
When it's $203 a share, you want them to be paying a dividend if you want some return directly to a shareholder. That's the way you can do it. And then, of course, as you talked about, the Florida sues Disney over everything that's going on with their parks and their new developments and everything. So that's in the news. Who doesn't know about that?
Yeah, everybody knows about that.
Yeah,
they've also invested $1 billion in one of their parks, the Star Wars park, and they shut that down after a year. So there's a lot of things there that we have to sit there and be apprehensive about.
Have you been to Disney World?
Disney World once, Disneyland twice.
Okay. I went when I was 10.
Yeah, I was 9 when we went to Disney World, or 10, and I did not like it.
Yeah, I remember I didn't like it when I was 10.
All right, analyst estimates. Now, this is something, guys, that concerns me about the profit margin. Because if profit margin is going to go back to normal levels and their revenue is increasing, it should jump up faster than this. They're showing $4.16 here to $9.23. It's almost doubling exactly, but it's going to take 5 years to get there, even though they have record revenue.
Yep.
And then you look at their revenue here. They're still growing their revenue, according to analysts, at single digits, low to mid single digits. Remember, guys, analysts have the same biases you have. You have to remember that. They want to get Disney work. So they're going to sit there and say whatever people need to hear about Disney so Disney loves them. That's the big thing. And that's where I sit there and say, don't put too much credence into analysts. It is a way to look at it and say, what are they thinking? Because they do talk to these companies a lot. But the further and further you go out, they're guessing just as much as anybody. Just as much as anybody. And you got to remember that. Now, the way I look at it is, okay, it's a big company. Well, can they really grow revenue? Yeah, probably mid-single digits, going to be high side. But I look at this profit, and this is what blows my mind, Mo. I'm just surprised by this.
Yeah.
They're going to go revenue from 90 billion to 110, but profit's only going to double, even though their historical margins are way higher than they are today.
Right. Yeah, I've been apprehensive about this one for a while.
So guys, let's go to our stock analyzer tool. Most popular part of our site. It's one of our many tools, including Mo and I, up here. All these tools here, and our community of like-minded investors, thousands of people in there. Guys, investing is hard, especially hard when you're alone. That's why the software makes so much sense. $7 for 7 days. Come try it out, risk-free, $1 a day. Trust me when I say you will not regret it. Come check it out. So let's do our analysis on Disney right now. Let's do a 10-year analysis. So Mo, So look at this 10-year ROIC
That's
of 7
exactly what I was looking at. But then I was thinking it could be skewed because of COVID.
Well, yeah, because look at this. The last 5
Exactly.
years have been 3%.
Exactly. So it
Guys-
doesn't really scare me off.
The reason we put ROIC in here is this is the return the company gets in the business, on the money invested in the business. The more of a moat, the higher the ROIC should be, right? And you should pay a premium for that. This is kind of scaring me because it's been skewed significantly, probably because of COVID and these lower margins, because ROIC is calculated based on operating profit. And if operating profit's down a lot, I mean, let's go look at the income statement. I mean, look at this. Look at how much it's down. Here's income from continuing operations. 6.7, 8, 8.85, 9.8, 9.4, 13, 10.9, negative, 2.5, 3.5. How?
Yeah.
Mo, give me your assumptions about the future. And I want you to factor in low side, margins staying the same or slightly getting better. Man,
So for revenue growth, why don't we do 3, 5, and 7?
I like it. Okay, what about profit margin?
So for profit margin, I'm almost inclined to go 4.5, 7.5, and 9.5. Or do you want to get it back to that 10.5 number?
Well, that is 10.5 then if you do equal.
Oh, okay.
4.5, 7.5, 10.5.
Okay.
But guess what? This 10.5 is skewed by the last 5 years.
Yeah.
Like
So go-
literally
go
before
higher,
then it
go
was
higher.
15. That's what I think.
higher.
I think 4.5, 8.5, and then 13.5, which
Okay.
is higher than,
Higher, yeah.
yeah. Free cash flow. It's always been, if you look right here, their
always
free
been
cash flow has
less.
been lower than their profit margin. Not by much, but 80%. A lot of value investors will only look at a company if it's within 80%. So it's there in the last 10 years. So what do you want to do?
So you want to go 2, 6, and 2.5, 6.5, and 10.5?
Sure. I think it's a little low, but I'm fine with that.
Okay.
PE. High moat business. Even though the ROIC is not showing that, but not a lot of growth.
Yeah. 17, 19, and 21.
So I like this, and here's why. 17 PE sounds high, right?
Yeah.
But guess what, guys? This is pretty bad.
Very beat up.
That's very, very beat up. Very, very beat up. Do the same thing for price of free cash flow?
Yep.
Okay, now your desired return, Mo.
How about 11?
Oh, wow.
What, you want to go
Go for it.
higher?
No, I thought lower.
Oh,
Mo, we beat the crap out of this thing down here. I'm okay with doing 10 for me, but if you want to do 11, let's do 11.
okay. I was going to go 11, 13, and 15.
Okay.
The high side is there's a lot of unknowns, a lot of guesses that they're going to get back to those margins.
And 7% growth.
And that.
So guys, remember, stick with us for this entire video. I want you to hear our whole explanation on our stock analyzer tool. All right, look at how bad this looks.
Why?
17 to 30, 82 to 106, 45 to 62. If you paid today's price and the low assumptions occur, you're going to lose 8.8% according to our assumptions. If you pay today's price and the middle assumptions occur, you're going to make 4.5%. If you pay today's price, the high assumptions occur is 14. This is one area where I actually don't agree with this. I do think the value is
think it's-
closer to this.
I'm actually looking at your watch list number, and I think that's probably the right number.
That's what I look at it as. Guys, I do think they'll figure out a way to get back to normalized profit margin. I don't see how a company drops its profit margin by 66% with this kind of moat and it stays that way.
And when it comes to all this, the government stuff between Florida and them, it doesn't concern me.
Yeah, Florida's not going to be dumb. And it's all posturing for presidential election.
Correct.
That's all it is.
Correct.
All right, guys, that's our company. But look at this. This is a prime example of when we deviate from the stock analyzer tool. Because it's a moat, it's a big business. Thank you very much for your time.